In this video, we will look at 3 different tax scenarios with minor differences so you can see the impact and further understand how your decisions impact your taxes. These scenarios will be simplified for educational purposes, and you may want to seek the help of a knowledgeable tax advisor for your own situation. These scenarios also only illustrate federal tax requirements. Discussing state or local taxes is outside the scope of this training. Our first example is Pastor Allen. Pastor Allen is paid a salary of $60,000 annually. Of that salary, he designated $33,000 as his housing allowance last year. He's also married, but his wife didn't work, and they had 3 children in the home full-time. For this illustration, we'll assume that he spent $35,000 on housing expenses, and the fair market value of his home as a furnished rental was $36,500. That means his designated amount is the lowest of the 3 housing values and will be the amount excluded from his federal income tax calculation. Pastor Allen is still participating in the Social Security and Medicare programs. The first step we should take in establishing how much tax Pastor Allen owes would be to calculate his Social Security and Medicare tax. When you have not opted out of Social Security and Medicare, the total amount of wages used to calculate your Social Security and Medicare tax includes both your taxable wages and your designated housing allowance. There are some deductions from the self-employment tax available, such as unreimbursed mileage, but you should consult with a tax professional before claiming these. In Pastor Allen's scenario, he's going to pay 15.3% of $55,410. You might be wondering why we don't calculate the 15.3% on the full $60,000. The IRS essentially lets the first 7.65% of the wages be excluded from the 15.3% calculation. They also let you deduct 50% of your self-employment tax from your taxable wages when calculating your federal income tax. In Pastor Allen's case, his total self-employment or Social Security and Medicare tax is $8,478. After we've calculated Pastor Allen's self-employment tax, we can use that number to calculate the total federal income tax amount owed. Again, we know his wages are $60,000 and his excludable housing allowance is $33,000. That $33,000 is the lowest of the 3 housing values since he actually spent $35,000, and the fair market value was $36,500. Allen and his wife also are eligible to receive the standard deduction. In 2024, that is $29,200 for a married couple filing a joint tax return. The standard deduction is an amount of money that the IRS allows everyone to earn before wages start getting taxed. But it doesn't have anything to do with the fact that you're a pastor. Pastor Allen also gets to deduct 50% of his self-employment tax, which is $4,239. So, if you take his total wages of $60,000 and subtract all of those deductions, his taxable income actually goes all the way down to 0. Without the housing allowance, he would have owed federal income tax, but with $0 in taxable income, the total federal income tax due is also $0. Putting together Pastor Allen's tax situation, we see that he owes $0 in federal taxes and $8,478 in self-employment taxes, for a total of $8,478. But let's say that Pastor Allen also had a W-4 on file that requested the church withhold $350 per month as voluntary federal income tax withholding. That would amount to $4,200 throughout the year that had already been sent to the IRS on Pastor Allen's behalf. Based on his earnings and the number of children that he has, Pastor Allen would also be eligible for the child tax credit. But because of limitations on this, he wouldn't be eligible for the full $6,000 credit. In this scenario, he would receive $3,039. He would also be eligible for a partial earned income credit of $1,605. On his tax return, which is Form 1040, he would calculate the total amount owed less any of the credits or payments already made to determine if more is owed, or if he is due a refund of any overpayment. In this case, his taxes were slightly overpaid, so he would receive a refund of $366. Now let's look at a second example. Pastor Frank has the exact same situation as Pastor Allen, except he opted out of Social Security and Medicare by submitting a Form 4361. In step 1, where we calculate the Social Security and Medicare tax owed, Pastor Frank would indicate that he's exempt from Social Security and Medicare, so his taxable amount would be zero, and his self-employment tax would be zero as well. To calculate his federal income tax, he takes the full $60,000 and excludes his $33,000 housing allowance and the standard deduction of $29,200. Notice that, unlike Pastor Allen, Pastor Frank has no deduction for half of the Social Security and Medicare tax because there is no Social Security and Medicare tax being paid. Still, Pastor Frank's taxable income is zero, and thus his total tax liability for federal income tax is zero. Now here is where this scenario gets really interesting. Pastor Frank owes no federal income tax and no self-employment tax. He also did not contribute any tax throughout the year through voluntary federal withholding or quarterly estimated tax payments. But because he is exempt from Social Security and Medicare tax, the tax credits that he's eligible for are based on his taxable wages, without including the housing allowance. This is a really important distinction in understanding the financial impact of opting out of Social Security and Medicare. When calculating these tax credits, which are based on your total income, having a housing allowance gives you control over how much you report as taxable wages. In this situation, by opting out and having a lower taxable income, Pastor Frank was eligible for a child tax credit up to $3,675 and the earned income credit up to $7,430. Both of these tax credits are refundable, which means that even if you didn't owe or pay any taxes, you can still get a refund of these amounts. So, Pastor Frank, having paid no taxes, will receive a check for $11,105. The refundable tax credits that both pastors were eligible for phase in and out based on your wages. If you make too little or too much, you're not eligible for those credits, so there is a sweet spot. For pastors who have opted out of Social Security and Medicare, you have much more control over finding that sweet spot by designating the right housing allowance amount. This is an advanced tax strategy, but it's worth considering when determining your designated housing allowance amount. In the graph on the right, you can see that the maximum earned income credit, which would be worth $7,430 for a family of 3, is earned when the family's reported wages fall between $16,500 and $28,150. Above $28,150 and below $63,350, you may still receive some tax credit, but the amount phases out as you earn more. Now, let's compare the pastors' situations. Remember that the only difference was that Pastor Frank had opted out of Social Security and Medicare. Pastor Allen received $5,000 per month in gross wages, but had $350 per month withheld from his paycheck. So his net pay was $4,650 each month. Though he received a refund of $366, he ultimately paid the IRS $3,834 in taxes for the year. Pastor Frank also received $5,000 in gross pay per month, but he did not have any federal income tax withheld. So, each month, he received the full $5,000 of pay. He also received a tax refund of $11,105 and paid $0 in taxes for the year. Now, before we go imagining which size of TV Pastor Frank purchased with his tax refund, we need to remember that he does not have Social Security and Medicare to fall back on when he retires, so Frank also had to set aside significantly more than Allen for future use. It's also worth noting that these tax laws were written many years ago and still work best in a Leave It to Beaver traditional family where the pastor works full time at church for low wages, has opted out of Social Security and Medicare, and has a wife who stays home to raise multiple children. These laws haven't been updated in many years and are not as favorable to the modern family who may have fewer children, dual incomes, or higher wages, or who decided not to opt out of Social Security. In fact, let's take a look at a situation like that. Pastor Jim has the same situation as Alan, except that his wife is traditionally employed and earned $50,000 for the year. Pastor Jim's self-employment tax would be the same as Pastor Alan's. His wife's earnings aren't a factor because his wife is an employee for Social Security and Medicare purposes. That means her employer withheld 7.65% from her paycheck, contributed an additional 7.65% from the business, and sent it to the IRS along with the other payroll taxes throughout the year. For federal income tax purposes, the family makes significantly more money, with total wages coming in at $110,000. Pastor Jim receives all of the same deductions as Pastor Allen, but is left with a taxable income of $43,561 and a federal income tax of $4,789. I'll pause here for a moment to clarify a concept that is commonly misunderstood. Did you know that as you earn more and reach higher tax brackets, only part of your wages are taxed at the higher rates? Earning more does not move all of your income into higher tax brackets. Sometimes people get concerned about earning more because they would be in a higher tax bracket. But since only the additional earnings are taxed at the higher rate, there isn't a significant consequence for earning more, except when phasing out of tax credits. In Pastor Jim's case, he has $43,561 in taxable wages. The first $22,000 is taxed at 10%, and the portion between $22,000 and the full $43,000 is taxed at 12%. Looking at Pastor Jim's total taxes, we see that he owes $13,267. But since his wife had $5,000 of federal income tax withheld during the year, and Jim made quarterly estimated tax payments of $500 each quarter, they have already deposited a good portion of their tax bill. Though the couple is not eligible for any earned income credit because of their higher wages, they are still eligible for the full child tax credit of $6,000. As a result, they are left owing the IRS $267 by April 15th. Pastor Jim and his wife did an excellent job planning ahead and estimating their tax payments, so they did not end up with a significant tax bill at the end of the year. You too should plan ahead to avoid unpleasant tax surprises. Since there are more words in the United States tax code than in the Bible, it is important to ensure you understand the core concepts illustrated in this video course to improve your financial literacy and be properly prepared to render to Caesar what is Caesar's, and not a penny more.